Hello, Mambo, Habari. Best wishes to you wherever you are. My name is Danish Eqbal. I am currently the Senior Advisor for Strategy, Data, AI, and Transformation for Africa and Asia regions. Today, we are here to talk about Agentic AI in insurance specifically. And we want to navigate through the playbook that I, in my last decade of experience, has been able to witness and to create. I think the larger message that I want to give through this talk is about stop counting pilots and start counting the P&L. So let me start with a question that I want everybody in the audience to reflect honestly. How many AI pilots is your organization running right now? 10, 20, 50? Now, how many of them are on your P&L account, profit and loss account? I've spent the last decade in insurance across 3 continents, building AI, ML, analytics teams in India, leading P&L as a CEO in Africa. And today, I am also here as somebody who has chaired the Data AI Analytics Committee across multiple markets for one of the Africa's largest banking groups. And the pattern I see everywhere is the same. We are drowning in pilots and starving for outcomes. MIT's NANDA research found that 95% of enterprise AI projects deliver no measurable P&L impact, despite $30 to $40 billion in global spend. Gartner tells us 40% of agentic AI projects will be cancelled by 2027. IDC found that for every 33 AI POCs a company launches, only 4 graduate to production. That's the crisis, and it's entirely avoidable. Let's be clear about what we are talking about. Agentic AI is not your chatbot with a new name. It's not an upgraded co-pilot. Agentic AI is a system that plans, decides, uses tools, remembers context, and executes multi-step workflows with minimal human direction. The difference matters enormously in insurance, because insurance is not a single decision. It is a chain. First notice of loss, coverage check, fraud flag, settlement authority, and payout trigger. Every single link in that chain is a target for an agent. McKinsey estimates AI could unlock $1.1 trillion annually for the global insurance industry. So the technology is not the problem. Now let me bring about a thought as to why 88% of insurance AI is still stuck in pilot or POC purgatory. Because there are 3 specific failure modes, and almost every organization I have seen or worked with is running straight into at least one of them. Failure mode 1, you build for the demo, not for the workflow. A pilot that works in a sandbox, clean data, controlled scope, enthusiastic team, dies in production when it meets legacy core systems, bank data handshakes, and regulatory edge cases. The Allianz Nemo team understood this. That's why they started with one workflow, food spoilage claims under $500, and only expanded after it worked at scale. Failure mode 2, your data isn't ready, but your PowerPoint is. In Africa, where I operate, research shows that up to 50% of insurance data is inaccurate by the time it's analyzed. In India, despite Aadhaar and account aggregator, spaces like fragmented KYC across bank insurance partners are still the silent killer of AI deployment. IDC found that 88% of AI POCs never reach production, not because the model failed, but because the organizational readiness for data process and infrastructure wasn't there. The model, so, is the easy part. The data highway is the hard part. Failure mode 3, and this one is personal, the ROI translation gap. Your data science team measures model accuracy. Your CFO measures loss ratio, cost per policy, and retention rate. These are not the same language we are speaking. And the absence of a translator between them is why most AI initiatives never get the budget to scale. I have lived both sides of this gap. I built predictive models at Tata AIA. I own a profit and loss account at Africa as my CEO position. The person who has stood in both rooms understands one thing. AI deployed without a commercial anchor will always be defunded before it delivers. So what separates the 5% that succeed from the 95% that don't? I want to give you a framework today. You can take back to your organization. I call it DQ stack, which means detect, decide, and deliver. Detect. Your agent surfaces the commercial signal. A lapse risk score 45 days before policy anniversary. A fraud anomaly in a claim submission. A renewal trigger from bank assurance data. Decide. Your agent recommends or within defined authority limits executes the action. Renewal offer, premium adjustment, claims fast track or escalation, and critically human in the loop on every high stakes decision. This is not optional. IRDA's fraud monitoring framework, RBI's free AI guidelines, and EU AI Act all require explainability and audit trails for insurance AI decisions. The third in the DQ stack is deliver. Your agent drives a P&L outcome you can measure. McKinsey benchmarks, for example, 3 to 5 percentage point loss ratio improvement, 20% to 40% reduction in customer onboarding cost, 10% to 15% premium growth for AI leaders. The reason most organizations get stuck is that they build, detect, declare victory, and never connect the chain to deliver. Here's Bajaj Allianz in India. Their AI stake cut per policy processing time by 60%, and 96% of non-investigative death claims are now settled within a day. That's detect, decide, and deliver, working as a system. So what do you do? Where do you start? Right here, 3 stages. Day 0 to 30 is diagnose. Map every AI initiative to one P&L domain, just one P&L domain. Score your data readiness honestly, completeness, freshness, AI fitness, and audit your governance across IRDA's and RBI's guidelines on AI and fraud monitoring. Day 30 to 90, ship one agent, one bounded workflow. Bajaj Allianz 1-minute policy issuance was not a 3-year transformation. It was one focused deployment done right. Copy that discipline. Day 90 to 120, scale or kill. 3 of these 4 conditions must hold. For example, 50% cycle time reduction, under 1% error rate, and auditable decision trail, 0 regulator escalations. Hit 3 out of 4 and you will have a P&L bridge. Miss them, kill the pilot. Keep the data and go again. That's the whole playbook. And let me close my talk with the only 3 things that I want you to walk away with today. First, pick one domain, not a use case, just one domain, claims or underwriting or fraud or retention, and commit to it, measuring against a P&L KPI from day one, not accuracy, not F1 score, but loss ratio, cost per claim, retention rate. Second, treat your data infrastructure as the product. The D-Cube stack only works if the data highway is clean, current, and connected across your bank assurance partners, your core systems, and your digital channels. Spend 80% of your first 90 days on data readiness. The model, remember, is the last 20%. Third, govern to scale, not to comply. RBI, IRDA, EUAI, all these acts are not obstacles. Remember that. They are the architecture that lets your agents operate at scale without a regulator shutting them down. And that's very important. Build the governance stack the way Bajaj Allianz built their shadowing technique, not to satisfy an auditor, but to earn the trust of every customer your agent touches. The insurers who will win the next decade are not the ones running the most pilots. They are the ones who had the discipline to kill the pilots that couldn't reach the P&L, and the commercial courage to scale the ones that could. So stop counting pilots and start counting P&L. Thank you.